Thank you for joining us. This is Business Incorporated coming to you live from our Lagos studio. I'm Chimizi Obi Iwago. Today on the show, Nigeria's Debt Management Office sells 5- and 10-year debt at a flat rate of 15% at an auction, raises more than the 100 billion naira it wanted to raise. And Kenya's foreign debt investors take election turmoil calmly. Plus, Angola LNG launches sell tender for cargo loading next week. Let's get started now with the markets. And here in Africa, the Nigerian Stock Exchange, the index was in the red at intraday, down 0.30%. Mobile, Nigerian breweries and international breweries were the top decliners. However, the market in South Africa and Egypt were up 0.70% and 0.68% each. In Kenya, the market is closed for the election but closed up 1.31% on Tuesday. While many Kenyans fear today's election rerun will provoke serious trouble, foreign investors are cautiously confident that the country's debt can ride out the crisis, although they remain hesitant about local stocks. Their base scenario is that the vote can conclude largely smoothly. However, given that Kenya's external debt is rated B+, but trading at levels more than akin to bonds, with rating 2 notches lower, this means assets have already adjusted to the uncertainty, and any negative surprises may have less of any impact. And Nairobi's $1.5 billion standby facility deal with the International Monetary Fund provides additional comfort. Meanwhile, Nigeria's Debt Management Office has raised a total of 121.13 billion naira from bond auction on Wednesday, more than the 100 billion naira it wanted to raise. The DMO sold a 5- and 10-year debt at a flat rate of 15% at an auction on Wednesday to curtail borrowing costs as inflation declines. The DMO sold 3 billion naira of the 2021 paper and 97 billion naira of the 2027 paper at 15%. It allotted 21.13 billion naira of the 10-year debt on a non-competitive basis. Borrowing costs for the government have fallen from as high as 18% a few months ago as inflation has slowed, helping the state raise money to cover a gap in its budget. And in the Middle East, shares in First Abu Dhabi Bank, the largest bank in the United Arab Emirates, dipped 1.9% today, the day after it reported an 18% drop in third-quarter profit. Financial sector stocks helped drag the Abu Dhabi index down 0.70% at intraday. Elsewhere on the exchange, shares in Etisalat, the United Arab Emirates-based telecom group, edged up 0.05%, following its reporting on Wednesday of a 29% increase in third-quarter net profit. In Dubai, shares in Emaar Properties and Emaar Malls dropped 0.7% and 0.9% after Emaar Properties said an initial public offering in its development unit would be a similar size to the offering of Emaar Malls when it was listed on Dubai financial market in 2014. The Dubai market was 0.23% down. Saudi Arabian stocks opened largely flat, but at intraday the index was down 0.28%, and in Qatar the index was down 0.03%. Move on now to Europe, where market hovered around the flat line in early trade as investors digested new earnings report and waited to hear from European Central Bank President Mario Draghi. And Draghi is about now making his announcement. Let's bring in Daniel Cook, my colleague in Frankfurt, to talk to us about this. Good afternoon, Daniel. Thank you very much for joining us. Good to see you again.
Hi there, Chimi. It's a day with lots of stories, lots of breaking news. I hope you're doing very fine.
Sure, I'm doing good. So right on, all eyes on Frankfurt today, where the European Central Bank is about now announcing its latest rate decision. What comforting message do you think Mr. Draghi has for the markets, the investors, and the region's economy as a whole?
Yeah, the press conference is just about to start here, but I can also already tell you some details about what he's most likely going to say. You know, we have this discussion here for a long time about higher interest rates that many people are asking for, and also for a stop of this bond purchasing program that was enforced during the financial crisis. We are now hearing that for the moment at least and until September 2018 there are not going to be higher interest rates. It's going to stay at this 0% interest rate policy here in the Eurozone. On the other hand, we are hearing that there is going to be a reduction of the bond purchasing program. The European Central Bank is pumping every month about 60 billion euros inside of the market. We are hearing that starting from January 2018, there's going to be a reduction from this 60 billion euros per month to just 30 billion euros a month. Still lots of money. I'm also already getting first reactions from traders and also from investors here. They're saying that this is a good move, a date that they have been waiting for a long time already. They are saying, though, that they don't really understand why at this point there are not yet those higher interest rates. We remember that Mario Draghi was always saying the reason is mostly the inflation rate that he wants to have at this 2% level. We are not yet at this 2% level, that's true, but also not very far away from that. It's kind of, this scenario when you take a medication, and that's what analysts are telling me, that, sometimes it's also not good to reduce the medication from one day completely to zero. So this seems at least a small, a slow process to, a change of this monetary policy that many people have been asking for. Let me also tell you about the shares here today at the blue chip index DAX. We have seen in the last days that the blue chip index DAX was really struggling with this magical, with this psychological important 13,000 point mark. After the news just came a few moments, out of this reduction of the bond purchasing program, shares here were also jumping again.